Today we are going to cover NPV calculation. We are going to use the question from the F9 Financial Management Question Bank. Question number 24 is called Paradise. So it's adapted from June 2004 from one of the ACCA question papers. Now let's read the required. Explain the main principles used to differentiate between relevant and irrelevant costs for investment appraisal, using the information in the question to illustrate your points. 5 marks. B. Calculate the project's net present value at the company's required rate of return. Conclude as to whether the company should accept the offer or continue with the project, giving a reason for your conclusion. 16 marks. Calculate the internal rate of return IRR for the project. That's 4 marks. Total 25 marks. Let's read the scenario. Proposed investment NPV and IRR Paradise Limited. Paradise Limited is a large company specializing in luxury holidays for the rich and the famous. It has recently purchased an uninhabited island close to the popular resort of Lucca at a cost of 2 million. This 2 million is a sunk cost because it has recently purchased. So this has been purchased. So before making this decision, so whether we make the decision to offer the island or to develop the island, this is already incurred, so it is a sunk cost. The company has already spent 1.5 million on preparing the land for construction work. Also, this 1.5 million is a past cost or is a sunk cost, so it's not relevant for decision making, so we will not include it when calculating the NPV. Over the next year, it plans to develop the island extensively with the aim of making it one of the most exclusive holiday locations in the region. An offer has just been made to buy the land for 5 million. So what does this mean? It's either we sell the land for 5 million or we develop the land. When we develop the land into luxury holiday, we will forego this 5 million. So this 5 million becomes an opportunity cost. Paradise Limited has therefore decided to reappraise the project in order to decide whether they should still proceed with the project or should instead accept the offer. If they decide to accept the offer, the sale will take place immediately. Immediately means in year 0, incurring legal fees of $20,000. So what does this mean? It means when we are selling the land for 5 million, we will incur the cost of the legal cost of 20,000. So which means we will not receive the full 5 million. We will receive 5 million net of 20,000 legal fees. If they reject the offer, development will continue and accommodation will be available for rent in 1 year's time. The project's accountant has provided estimates of costs and revenues for the next 5 years as set out below. This 5 years is a very key important number as our project should run only for 5 years. The total construction, right? The approach for this question, we will have to be solving it note by note. So first of all, we have to read the notes, then we'll come back and solve each note by note. Construction costs for the 7 hotels on the island are 37 million. Of the total, 2 million has already been spent in the form of down payment of several construction firms. These down payments are irrecoverable. So before making the decision, the company has already spent 2 million as down payments which are irrecoverable. So these down payments are also past or sunk cost, so they will not be included in the NPV calculation. Therefore, this 37 million, we have to say 37 million minus the 2 million sunk cost. Only the relevant cost will be 35 million. Note number 2, total construction costs for the 40 luxury self-catering lodges that will be attached to the hotels are 24 million. A down payment of 4 million is required immediately. That is in year 0. The cost of furnishing the hotels and lodges is estimated at 3.2 million. 4. Each lodge will have its own private swimming pool. The cost of each pool is expected to be 12,000. 6 restaurants will be built on the island at a cost of 15 million. Paradise Limited has already had to commit to 3 million of these costs in order to attract the chefs it requires. Although these monies have not yet been paid over, Paradise Limited is contractually bound to pay them irrespective of whether the project now proceeds. So this 3 million already it's a committed cost, so it's irrelevant for decision making. 6. A small paradise of shops will be developed at a cost of 4 million. Annual cash overheads are expected to be 2 million for the hotels. Revenues for the hotels are estimated at 13 million per annum. 8. Maintenance costs for each of the lodges will be 7,000 per annum compared to the rental income of 390,000 per annum per lodge. Depreciation totaling 1.5 million per annum will be charged in Paradise Limited's accounts for the hotels, lodges, restaurants, and shops. 10. The restaurants and shops are expected to generate net income of 4.73 million per annum in total. Interest on money borrowed to finance the project will be 2.5 million per annum. All setup costs will occur within the next year before the resort is open. The annual revenues and overheads relate to the 4 years following this. Assume that all cash flows occur at the end of each year unless otherwise stated, and that there are no terminal values to consider at the end of 4 years. The company's cost of capital is 10% per annum. Right, we are told here working should be in thousands to the nearest $1,000. Right, let's solve this question note by note. Before we solve it, let's read the last paragraph. It's saying all setup costs will occur within the next year before the resort is open. This means that every cost that is not specifically told that is in year 0, it should be in year 1. Now let's go and solve the question note by note, starting from note number 1. We know that the project will run for 5 years. Then the costs will either be in year 0, and those that are not specifically told to be in year 0, they should all be in year 1. Now note number 1 is saying total construction costs for the 7 hotels on the island are 37 million. Of the total, 2 million has already been spent in the form of down payments to several construction firms. These down payments are irrecoverable. So the 2 million is irrelevant. Then what is relevant is 35 million. So let's start construction. We have got hotels. We've got hotels. We are working everything in thousands. So we'll say 37,000 minus 2000, that is already spent. We get that. Then note number 2, total construction for the luxury self-catering lodges. So construction of lodges, we are told that a down payment of 4 million is required immediately. So in year 0, we have 4 million. Then in year 1, the total is 24 million. So in year 1, we will have 20 million. Then note number 3, the cost of furnishing the hotels and lodges are estimated at 3.2 million. So furnishing lodges and hotels is 3.2 million, so it's 3,200. Then we are told that in note number 4, each lodge will have its own private swimming pool. The cost of the pool is expected to be 12,000. So swimming pools, which is minus 12, because we are making everything in thousand. How many lodges are there? We are constructing, as in note number 2, 40. So it's 12 by 40. It's 480. It's a cost. Then note number 5, 6 restaurants will be built on the island at a cost of 15 million. Paradise Limited has already committed to 3 million of these costs. So restaurants, there are 6 of them, at a cost of 15 million, but we need to subtract the 3 million because it's a committed cost. We are left with a relevant cost of 12. Number 6, a small parade of shops will be developed at a cost of 4 million. So we have to construct the shops. Construction shops at 4 million. Then number 7, annual cash overhead are expected to be 2 million for the hotels, and revenues for the hotels are estimated at 13 million. So overheads, hotels. We are told here in the last paragraph that the annual revenues and overheads relate to the 4 years following this. So 4 years following this, it means from year 2 up to year 5. So we have got overheads and a cost of 2 million. So it's to be 2,000 for all the 4 years. Then we've got revenues. Again, for hotels, they said revenues are 13 million, so it's 13,000 for 4 years. Then we come to note number 8 to say maintenance costs for each of the lodges will be 7,000 per annum, compared to rental income of 390,000 per annum per lodge. So we've got maintenance This is lodges. The maintenance is 7,000, so it's 7 multiplied by the number of lodges. The lodges, we're given the number of lodges in note number 2, that is 40. So 7 by 40, we get 280 for 4 years. Then rental income. Again, for lodges, the rental income for lodges will be 390,000 multiplied by 40 lodges. So it will be 15,600 for 4 years. Then note number 9, depreciation totaling 1.5 million per annum will be charged in Paradise Limited accounts for the hotels, lodges, and this depreciation is an irrelevant cash flow as it is a non-cash flow. If we were given capital allowances and also the tax rate, we were going to calculate the tax saving on capital allowances, because capital allowances is the allowable tax depreciation. So this 9 is irrelevant. Then let's go to note number 10. The restaurant and shops are expected to generate net income of 4.73 million per annum in total. So net income, that is shops and restaurants. Which is 4.73, which is 4730 per annum. Then let's go to number 11. Interest on money borrowed to finance the project will be 2.5 million per annum. The interest payments are an irrelevant cost, as the interest charge is factored into the discount rate. When calculating the discount rate, the interest percentage is factored in, so the interest payments are a disallowed expenditure. They are not a relevant cash flow. So now let's finish off our question by taking care of the opportunity cost that we were given in paragraph 2. An offer has just been made to buy the land for 5 million. So when now we are developing this land, we will forego this 5 million, but not the whole 5 million. The 5 million net of the legal fees of 20. So we say opportunity cost that is offer foregone. So the offer foregone will be now, that is year 0. So forego the 5,000, the million in thousand, less 20, which is 20,000. We'll forego 4,980. Then now we can calculate our total cash flows. So here we'll say sum, that from the top, you get that sum, you can copy up to there. So we have our total cash flows, then we discount 8. %, the discount rate. We are given the discount rate here. The company's cost of capital is 10%, so we discount at 10%. In year 0, the discount rate is 1. In year 1, the discount rate is 1 divided by 1.1. In year 2, it's year 1 divided by 1.1. Then we can copy the formula up to year 5. Or we can easily copy these discount rates from our our present value tables. Then we get our PVs. Our PVs would be simply cash flow multiplied by the discount rate. Then we can copy the formula to year 5. Then now we can calculate the NPV, which will be the sum of all the present values. We get that figure 12606. Therefore, the NPV, it's a positive. The company should go ahead and develop the island into a resort location. Then when using computer-based, we can use the NPV function from Excel. We'll say equals NPV, what is the rate, discount rate, which is 10%. Then what are the cash flows? Mind, you should take the cash flows from year 1 up to year 5 only. Then out of them, you subtract the initial investment, the cash flows from year 0. Then we get the same discount factor as 12606. There will be slight rounding differences, as here the formula we didn't round off as the present value tables. So here that's how you are supposed to get your 16 marks of the NPV calculation. So let's briefly talk about Part A. Part A is saying explain the main principles used to differentiate between relevant and irrelevant cash flows for the investment appraiser, using the information in the question to illustrate your points. So now the irrelevant cash flows, they are the cash flows that are not relevant for decision making, that we will not use them when computing the NPV and deciding whether to go ahead with the project or offer the land for 5 million. So in this instance, when we go ahead and develop the land, the 5 million will become relevant, as it will be a foregone benefit. We have gotten ourselves 5 million when we offered the land, but when we develop it, we will forego this 5 million. Net of the 20,000 legal fees will become an opportunity cost. And again, we have already said the cost of purchasing the land to this 2 million is already a sunk cost because we have already purchased the land. So it's irrelevant for decision making, because whether we offer the land or we develop the land, this 2 million is already incurred. And also same applies with this 5 million for the preparation that has already been spent. Whether we offer the land or we develop the land, we have already incurred that one. Then on note number 1, we have got this 2 million that has already been spent. It's also a sunk cost, so it's irrelevant for decision making. That's why we say 37 minus 2 million, we got the relevant cost as 35 million. Then in note number 2, everything is relevant, as the 4 million is a down payment immediately when we are developing the land, and the whole 24 million will arise as a consequence of what? Developing the land. So it's a irrelevant cost. The 3.2 million is relevant. Note number 4, the swimming pool is relevant. And let's go to note number 5. The 15 million, not the whole 15 million is relevant, but the 15 million less 3 million, which is 12 million, is relevant. Whereas this 3 million is irrelevant, as it is a committed cost. Whether we offer the land or we develop the land, we have already committed ourselves to paying this 3 million. So it's irrelevant. Then We've got note number 9, the depreciation. The depreciation is an irrelevant cost as depreciation is a non-cash flow item, so it's irrelevant. And also in note number 11, we have got the interest on money borrowed to finance the project. This is an irrelevant cash flow as the percentage of the interest is factored into the discount factor. So the absolute interest payments are irrelevant as the interest percentage is factored when computing the cost of capital to appraise the project. Thank you very much, guys. Do not forget to subscribe to my channel. Thank you.